The Panic of 1907 is one of the most dramatic calamities in history. Why did it matter back then? It painfully exposed the US to the serious problem of not having a central bank. Its aftermath led to the creation of the Fed. Why does this matter to you today? It reminds us of the high frequency with which financial crises, panics, or manias reappear, despite the puerile misuse of the term equilibrium in financial economics. Back to 1907. Was it a crisis or a panic? Let's see. Joseph Johnson notes that 1907 was both a crisis and a panic. The panic occurred in October, and it was a local U.S. problem. The crisis had started earlier, in January, and it was a global problem, hitting all countries on the gold standard. Let's examine the context leading up to this crisis. The early 1900s economic boom in the U.S. was widespread. Inventions like the telephone, electric light, and automobile were seen as signs of progress. Joseph Johnson writes that railroad stocks more than tripled from 1897 to 1906. This tide of prosperity rolled on until 1907 with booming stocks, bank clearances swelling, and the average man convinced that good times, being deeply rooted in natural conditions, would persist. But old problems with the U.S. financial systems remained. Tolman and Mohn explain the flaws of the U.S. financial system. First, seasonal liquidity fluctuations were high and dangerous, as previously seen in our account of the 1873 panic. Country banks deposited reserves in New York banks and recalled them every autumn to move Midwest crops harvested. This drained money from New York. Interest rates in New York usually climbed significantly every autumn. Second, Tolman and Mohn explain the problem with the U.S. gold standard. In 1906, the U.S. Treasury attempted to stimulate gold imports by subsidizing finance bills. This spurred gold exports from Britain, the world's financial hub. But such exports then induced the Bank of England to hike interest rates, stemming gold exports. The U.S. was vulnerable to a liquidity squeeze. This is what happened in 1907. But what was the trigger? In 1907, with finance bills suspended, gold left the U.S. for Britain. The New York money market had very little cash as it entered the autumn season of high cash demand for crop harvests. Tolman and Mohn show that the panic was triggered on October 16, 1907. A speculator, Augustus Heinze, tried to corner the stock of United Copper and failed. The timing could not have been worse. The economy was slowing, the stock market had peaked months before, and money was tight in New York. At first, Heinze's stock market losses with United Copper did not appear significant. But Heinze was also the president of Mercantile National, a retail bank. The public also learned that Heinze's partner in crime in the United Copper scam, C.F. Morse, was the director of 7 New York banks, 3 of which he controlled. Unsurprisingly, a bank run erupted in all banks both men were involved with. Oliver Sprague notes that these suspicious banks held only 4% of all bank assets. Would a panic be limited? Were banks regulated back then? Yes. The New York Clearing House was a consortium of New York banks, formed in 1853, to standardize interbank transactions. It also provided member banks with emergency funds in times of crisis, such as 1873. As the 1907 panic was triggered, the New York Clearing House examined Mercantile National and concluded that it was solvent. The Clearing House announced it would support the bank, but Heinze must resign. On October 19, 2 banks associated with Morse also cried for help. The Clearing House announced it would support both banks, but Morse must resign from all his New York banks. The total amount announced to support the banks in trouble was then $10 million, or $350 million today. On Monday, October 21, Mercantile National resumed business with new management. The bank run stopped. The same happened with both banks connected to Morse. The panic seemed to be contained, but calamity was just around the corner. Also on Monday, October 21, the National Bank of Commerce announced it would no longer clear checks for the Knickerbocker Trust Company, the 3rd largest trust in New York. What was a trust company? Ellis Tolman explains. These were state-chartered financial intermediaries with vague charters, allowing trusts to do business that banks were prohibited to do. Trusts competed for retail deposits with banks in New York City. Trust companies never became members of the New York Clearing House. And thus, as a bank run erupted on the Knickerbocker Trust given rumors it was connected to Augustus Heinze, the New York Clearinghouse could not bail out Knickerbocker. On October 22, 1907, a vicious bank run forced the Knickerbocker Trust Company to close its doors. Panic spread. Many other New York City trust companies were struck with heavy deposit withdrawals. Deposit withdrawals was widespread across trusts and banks. Sensing mortal danger in this contagion, the presidents of 5 trust companies formed a committee to assist trust companies in trouble. But not all participants were willing to commit the money, and the effort collapsed. Their next step, they petitioned J.P. Morgan, New York's wealthiest financier, to help. Tolman and Moen write that, on October 23, Morgan sent an expert to Trust Company of America to appraise its asset. Having received a sound appraisal, Morgan sent $3 million, today's equivalent to $100 million, the same day. Aid came from additional sources. J.D. Rockefeller, then the world's richest person, committed $10 million, or $350 million today, to Morgan's rescue efforts. But the panic engulfing trust companies now spread to banks, which also suffered heavy deposit withdrawals. Tolman and Moen write that, still on October 23, the U.S. Treasury Secretary met with all major New York financiers, and next morning, the Treasury deposited $25 million, or $870 million today, in the national banks. Before October was over, the total bailout from the Treasury and others surpassed $70 million, circa $2.5 billion today, draining the U.S. Treasury. Tolman and Moen write that, by October 24, the call money that New York brokerage houses relied on was not available at any interest rate. The New York Stock Exchange president called for J.P. Morgan's help. The financier extended $25 million, or $870 million today, to keep the brokerages afloat. Whoever bought the top in 1906 lost more than half 1 year later. The Panic of 1907 occurred during a lengthy economic contraction, as noted by Joseph Johnson. This economic crisis, added to the financial panic and a crashing stock market, resulted in significant economic disruption. Industrial production dropped sharply. 1907 saw the second highest volume of bankruptcies to that date, while unemployment rose from 3% to 8% according to Bruner and Carr. Tolman and Moen conclude that, although trusts and banks were distinct, they shared the call money market, and were economically integrated. Banks recognized in 1907 that the runs on trusts would spread to the entire financial system, banks included. Because trusts were much less regulated than banks, riskier assets concentrated in trusts. Does this sound familiar to you? Have you heard of the shadow banking system? Tolman shows the 1907 and the 2008 global financial crisis are similar in at least 2 aspects. First, trusts in 1907 and investment banks in 2008 were outside the regulatory oversight of authorities, and thus did not have access to lenders of last resort in times of trouble. Second, both of these New York financial intermediaries were unregulated, and yet large enough to represent systemic risks. But something positive came out of the 1907 financial calamity. Tolman concludes that the repercussions of the Panic of 1907 contributed toward a successful political effort to establish a central banking institution, and attempts to reduce variation in the degrees of regulation across financial intermediaries. And thus the Federal Reserve Board was created on December 23, 1913. Our verified sources are here. Write to us in the comments section if your interpretation is different, or if you'd like to suggest other sources. Today's takeaway concerns financial stability. Recently, the former Goldman Sachs CEO and then U.S. Treasury Secretary Hank Paulson stated,
"When I came to Washington in 2006, markets were benign. I noted that financial turmoil seems to occur every 5 to 10 years, and we needed to be prepared."
Next, consider the U.S. shadow banking system in 2008. Shadow banks were financial institutions that did banking business, but outside banking regulations. Shadow banks then included investment banks, such as Lehman, insurance companies such as AIG, and mortgage originators. You will recall that many of these shadow banks blew up in 2008, just like trusts blew up in 1907. One would hope that humans actually do learn from history, and yet it turns out that a shadow banking system still exists today, and it's actually larger and more complex than ever. Look around today. Can you identify shadow banks? Some examples include private credit, fintech lenders, and structured finance vehicles. Is it possible that they take more risk because they are less regulated? Would you be surprised if any of these blew up in the next financial crisis? Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.